Wall Street isn't quite breathing a sigh of relief yet. Bespoke's Paul Hickey believes more near-term pullbacks are ahead. He joins us now. Paul, good to see you.
Good to be here.
Put what we've seen in context in terms of the 5% lower from highs.
Well, I mean, you got to put it in a little bit of perspective here. This was the longest stretch we went during this bull market without a 5% pullback. We've had 18 other pullbacks during this bull market. So far, it's been run-of-the-mill. The average is about an 8% decline over 25 calendar days, and we're about 5% over 20 calendar days. So it's going according to plan right now. More importantly, if you look at the sectors that have been leading the market lower, it's the sectors that have been typically leading the market lower during prior pullbacks. So looking at that, it's sort of very textbook pullback that we've seen. And so, I mean, at this point, I wouldn't see too much of things to worry about here. And another thing to worry about is that they say tops are a process rather than, you don't have inverted V tops. And so typically, even if, we are in a topping process for this bull market, you would expect to see at least a retest of the highs.
But you don't see, I mean, according to what you're looking at, you don't see necessarily a V. I mean, you don't see more downside, do you? Or?
No, right now, I mean, we may see a few percentage points, but I mean, for people thinking like this bull market's over, we're not viewing it that way at all.
You mentioned the V, right? I mean, to me, the market, like you said, the S&P is down 5%, but stocks like Boeing, which were massive market leaders last year, are down off of all-time highs very sharply, and 15% in a straight line. I mean, to me, that sort of price action, like you say, tops or processes, but some large leaders from last year are not acting like it. They're almost in crash territory. I mean, how do you account for that sort of activity?
Well, I mean, I think a lot of people will, say this isn't a good, valid reason, but you saw massive gains in 2013. People didn't want to necessarily sell positions before year's end to take the tax hit. They can delay it by a year by selling it in January. So that's one reason to look at here. And I mean, just unlike the prior two bear markets, in 2000, techs peaked and crashed, and then the market followed suit. In 2007, financials crashed and the market followed suit. This pullback, we're not seeing any sort of sector really falling apart here. We've mentioned the consumer has been weak, but I mean, it's down only a little bit more. This consumer discretionary sector is only down a little bit more than the overall market here. So, and they typically underperform during pullbacks. So it's not out of the norm yet.
So are you taking advantage at this point of anything that's pulled back in your view, banking on that outsized bounce when the market turns?
Yeah, so what we did for clients today is we sent out a report just looking at names that look attractive in our ratings, and then also two other criteria: that they've outperformed their sector over the year to date, and that they have reported earnings, because you don't want to get blindsided with an earnings miss. So taking the four sectors that typically lead us in rallies when we do get a short-term low, you have the consumer discretionary sector, so Comcast is a name that looks attractive there. You have the financial sector, Bank of America is a name that looks attractive there. Industrials, Alliant Tech Systems, they've reported two earnings triple plays, which means they beat earnings, revenues, and raised guidance the last 2 quarters. And that stock has held up very well during this pullback. And then materials, Dow Chemical, that stock's held up well. They reported earnings, and you have an activist investor there shaking things up.
All right, Paul, thanks for joining us. Appreciate it. Paul,
thanks for having me.
Bespoke.